So this was really interesting to me. I just came across some really good information that Stockmo posted, and it was talking about how the banks can actually take your money. So as we know, in the 2008 financial crisis, the government came in and they did a bailout. So the bailout was using taxpayers' money to bail out the banks that overextended themselves by giving out house mortgages without down payment, car loans without background checks, and to see if these people can actually afford it. And of course, when people default, because now they're out of a job and they can't make any money, they can't hold up for the loan that they got from the bank. Now the bank is out of money, so banks can go bankrupt. So as we all know, the FDIC insures our money that's persistent in the bank, but it only insures your money up to $250,000. So if you have more than that in a bank, it's a bit risky at this point in time. So let's talk about a bail-in. So a bailout, we all know the government comes in, uses taxpayers' money, bails out these institutions. So the FDIC covers up to $250,000. Everything beyond that is not covered, which means could be lost. That means if you have $500,000 in your account, only $250,000 is covered through the FDIC insurance. Now, how can this happen? Here, there have been hundreds of banks that went out of business in the past. Whenever banks give out too much money, as in no money down mortgages, no bankrupt checks, and financing a car, loans, this could be happen. So people default and banks lose money. We are living in a society of credit cards and people default on credit card payments. Everything is purchased on a loan. During the recession, this happens frequently and banks can go bankrupt. So after the 2008 financial crisis, European accounts that held more than $100,000 were seized. Imagine working all of your life, having saved for retirement in your 401k, your retirement CD, your IRA, and your bank, just to lose it. This is called a bail-in. We heard about a bailout. The government bails out banks. A bail-in provides relief to a financial institution on a brink of failure by requiring the cancellation of debt owed to the creditors and depositors of a bailout, which involves the rescue of a financial institution by an external party, typically the government, using taxpayers' money for funding. A bailout helps to prevent creditors from taking on losses, while a bail-in mandates creditors to take losses. A bail-in helps a financial institution on the brink of failure, requiring the cancellation of debt owed by creditors. Bailouts help to keep creditors from losses, while bail-ins mandate creditors to take losses. Any accounts that you have within the bank, the same bank, will be added together. So your savings, checking, retirement account will all be added, and the combined number is more than $250,000. Whatever is above this number is not insured by the FDIC. The best solution is to keep your money in different financial institutions. In other words, choose different banks and don't keep anything above $250,000 in one bank. So the easiest is if you have more than $250,000 in the same bank, take that money and divide it throughout different banks. You can have your 401k in one bank, you can have an IRA in another bank, and you can have your savings in a third bank, but everything that's above $250,000 in the same bank is not going to be insured by the FDIC. So that's good to know. It's good to know even in the future, if you don't have that much money in the bank, just remember there will be a time where you might have more than $250,000 in your bank account. So you want to make sure that you're safe. Anyway, so it's good to know. Thank you, Stockmo, for giving us this information, so it's very interesting. You can look up the FDIC website for more information. So I hope you like this video. This is Claudia. I see you next time. Goodbye.